Hello everyone, this is Professor Kent. Today's recording is Chapter 2. In Chapter 2, uh, we are going to be learning cost terms, the concept, and the classification um, of the different type of costs. So first thing we're going to learn is there's two type of companies you could have. One could be a merchandise company, and the second one will be a manufacturing company. So if it's a merchandise, means it's a retailer, merchandise, or a manufacturing company. So the difference between the both is if you're buying and selling the product, it's a merchandise. If you're producing a product and then selling a product, produce it first and then sell it, and that's what we are going to be doing today. Manufacturing, you're going to be producing a product before you could sell it. So when we think of a manufacturing companies have three costs. First one is a direct material, second one is direct labor, and the third one is the overhead cost, the manufacturing overhead cost. Our first cost is the material that go into make a final product is called the raw material. Raw material, there's two type of raw materials. One is a direct and the other one is indirect. Direct one is that is can be traced to the product, and the indirect cannot be traced to the product. So indirect material goes as a part of my manufacturing overhead. Again, you have a material that you use to produce a product is called a raw material. There's two types when you have a raw material. One, we have a direct, and the other one is my indirect material. Direct, that can be traced to the product. Indirect cannot be traced to the product. If it cannot be traced to the product, it will go to my manufacturing overhead. Again, the second one is my direct labor, the labor cost that can be traced to the individual unit or a product. It called a direct labor. And that cannot be, just like the one with material, if it cannot be traced to the product, it will be an indirect labor, and they go to your manufacturing overhead. Now if she's manufacture now we're coming to a manufacturing overhead cost. We know that indirect material and indirect labor is part of my manufacturing overhead, and also manufacturing overhead includes all costs of manufacturing except any direct labor or direct labor material. So direct labor has its own account, direct material has its own account. If we cannot fit it into direct material, then it will be my manufacturing overhead. Just going further with the classification of cost. Now we learned we have a direct material, we have a direct labor, and we have a manufacturing overhead. These two costs called a prime cost. It will be a multiple choice question. The material is the first thing, then we put a labor on it, and then we manufacture the product. So direct labor and direct material is a prime cost. Direct labor and manufacturing comes under the conversion cost. Now if somebody works overtime, so the next one is overtime. If when the employees work overtime, we call them an overtime premium. The overtime premium for all factory workers, so if they're factory workers, they will be part of my manufacturing overhead. If it's an overtime, a product specific overtime are part of the direct labor. So if you can trace it to the product and they're doing an overtime, it will be, if you trace it to the product and it's a direct labor and you're paying them an overtime, then it will go to as part of my direct labor. Non we learned manufacturing that when you produce a product, that any cost that cannot be traced to direct material or direct labor, it will be manufacturing. If there's some non-manufacturing costs, those costs are necessary. We call it marketing and selling cost is non-manufacturing cost. The other one is administrative costs, and that has your clerical costs, executive costs, any other organizational costs. these two costs are my non-merchant, non-manufacturing cost. Now we're going further. There's further in the cost, we have a product cost. We already know that you have a direct material, direct labor, and manufacturing overhead cost. What we need to do is we needed to move these costs to the income statement. When do we move them to the income statement? We move them to the income statement when we sell the product, when we sell the inventory. And then we have a period cost. This period cost includes all selling costs and administrative costs. So they are expense. If they're expense, they will be moved to the income statement. So let's do our first quick check before looking at the solution. Let's see what we could if we could answer this question. Which of the following costs would be considered as a period rather than a product cost? So we're looking for it. Which one is a period cost rather than a product cost? So we know that manufacturing equipment depreciation is a manufacturing, and it's a depreciation on that equipment. Sorry, my pen gone. So A, if it's a manufacturing, anything related to the manufacturing, it's an expense. It will be my product cost. So it's not my period. So the first one is my product cost. So I'm just going through here. So this is, if it's a manufacturing, we call it a product cost. So there, then property tax on corporate headquarters is a property tax that we're paying it on the headquarters. It's an expense, and it will be called a period cost. Direct material cost will be my product cost. Electrical cost to light the production facility. So it's a production facility. So we have a production facility, that will be my product cost. Sales commission that you pay to the sales people, it will be my period cost. The question was saying which cost is a period cost. So in this case we have a B, and E is going to be your period cost. If they ask for products, your these ones are my product cost, these three. So going further to check if we did everything right, of course B and E is your it is your period cost. So now next one is your classification. When we have a classification, we could have it on the balance sheet or we could have it on the income statement. So in this case, financial statement prepared by a manufacturing company are most complex than the statement for merchandise. Of course, merchandise, you're buying stuff and then you're selling it. But when you have a manufacturing, you have more costs, so that's why it's complex. Manufacturing company must account for production of its goods as well as the marketing. So manufacturing has to do both, to produce a product, the cost of producing a product, and your marketing and selling costs. Manufacturing companies, there have many costs that do not exist in the merchandise, and merchandise companies simply purchase goods from a supplier and resell it. So that's why their financial statements are simple compared to the manufacturing. So you learned in your financial accounting, we have a balance sheet. So the balance sheet will be different for manufacturing company and merchandise company. When you have a merchandise company, you're buying the inventory and then you sell that inventory. Under the manufacturing, you're going to have three other inventories. You're going to have a raw material inventory, you're going to have a work in process inventory, and you're going to have a finished goods inventory. So these are the three inventories that you will have if the company was a manufacturing company. So now going further, this is just what each one depends. This is raw material waiting to be processed, work in process, partially complete, and then some labor is put it in, some material is put it in, and some overhead is put it in. The next one is complete. Once it's completed, it's moved to the finished goods inventory, and from the finished goods inventory it is sold to the outside public. So now going to there's a difference, but of course if there's a difference in the balance sheet, there's going to be a difference in the income statement. You have seen it. You have a beginning inventory plus what you purchase is equal to what you have it available minus your ending inventory is equal to my cost of goods sold. So for what you, when you have a manufacturing company, what we have is we have a beginning, we call it beginning finished goods inventory. So finished goods inventory plus what we cost of manufacturing those finished goods and minus your ending finished good will be cost of goods sold. We're going to learn this a little bit more. What is cost of goods manufacturing? You have your direct material, direct labor, and we have manufacturing overhead. So these are the cost of producing the product. So now going further, is just say this is the basic equation of inventory. So we have a beginning inventory plus what you purchase equal to, they both has to be equal to ending plus what you taken out from the inventory. Or what you could do is you could do a T accounts. I always like to do a T accounts. So beginning inventory plus what you purchase, and this is going to be the end, and what you used will be credit. So let's see if we can put this theory into perspective. So again, you could do it in a T account before looking at the question. So if I do this, you can use this equation, or you could use a T account like I showed you, but you should get a same answer. In this case, the question says that my beginning balance in my inventory is 1,000. We bought 100. If we bought 100 altogether, we have 1,100 worth of the inventory. Then what happens is we sold 300, and what will be the ending? So they both has to be equal, and this is my X, and that will be my $800. Or you could do it in another way. My beginning is 1,000. You bought $100 worth of inventory. We have 300 that we sold, and we have 800 left. How did we do it? 1,000 plus the 100 and minus the 300 will give you 800. So your answer should be 800. So this is what it is. Now going to your next one. So it's saying, how do we calculate the cost of goods manufacturing? I briefly explained it. What we have is calculate the cost of raw material, direct labor, and manufacturing overhead that is used in production, and that will be calculate the manufacturing cost. Then what we do is then we move it to the finished goods, and then you're going to have a finished goods inventory. So this is, we call it a product cost. So this is a flow of your product cost. You have a beginning raw material inventory plus what the inventory you purchase equal to what you have it available to use in production, minus the ending is what you used in the production. If you used in production, that becomes your manufacturing. So first one is your direct material, then my next one will be my direct labor, and then the next one will be your manufacturing overhead. If I add them all together, that is called my total manufacturing cost. And then what we are going to do is then my next flow is you have a beginning working process that you did not complete last month. It'll be my beginning plus what you have your total manufacturing equal to your total work in process for period. And then what we are doing is minus what you have it left equal to your cost of its manufacturing. Again, we're going to be doing a lot of questions at the back of the chapter. So this is sort of the flow of your product, and one from the working process, what we do is it goes to the finished goods. So what we have is we have a direct material that goes into production, you have a direct labor that goes into production, you have a manufacturing overhead that goes into production. That is called total manufacturing cost. So that's what they said, that is your total manufacturing cost. Manufacturing cost, it goes into the working process. You working process beginning plus what your cost is equal to your total work in process. So that's total work in process minus what you have an ending equal to your cost of goods manufacturing, cost of goods manufactured. So that goes into your finished goods, and from the finished goods you are going to be selling to your outsider. So this is, if you don't understand the flow the way we showed it to you, there's another way of doing it. So there's a raw material, so raw material, direct labor, manufacturing, they all go into my work process. And then we have a product cost that relate to the product. Period cost is not related to the product, but it's the cost of the company that they have. Now this is a summary of the classification. It is very important to know when you prepare a financial statement for the external external for the external users. What we have is, we will have a product cost and we will have a period cost. Product cost is your direct material, direct labor, and manufacturing. Period is your non-manufacturing. So anything that is non-manufacturing is example of is marketing and selling and administrative cost. That is your period cost. Then what we have is predict. Then what we have is predict cost behavior in the response. If your your variable expense changes according to the activity, they are called variable cost. If they does not change, they will call the fixed cost. Now then we're going further. We have a direct cost. That direct cost can be easily traced to a product. It's called the direct. If it's not traced to the product, they will be called an indirect. Now making a decision. So of course, when we think of a cost benefit, differential cost, difference between the alternative. Sunk cost is the cost does not affect your decision. The opportunity cost is foregone benefits. So what do we mean by these? Are some of the costs that you will see in this chapter. Now going to the next one is, what is the cost of a material that is used? So that's what we're looking for it. So what we have it, you have a beginning material, that material inventory. So what we have is, we have a beginning inventory. In this case they told us it is 32,000. That's your beginning inventory. What we did is, during the year we purchase our raw material. So we have a purchase. We have a, what did we purchase? We purchased a raw material. How much we purchased it? 276. Then what does that give you? Your total raw material. So we have a total raw material. If I add both of them, that is my total raw material to be used in the production, for use in the production. If I add them together, that is your 308 minus your ending raw material. In this case they told us it's 28,000, and then tells me the raw material, the direct raw material that we used in the production. So the raw material that we used in a production will be the difference between the both. In this case it will be 280,000, and the answer should be 280,000. So you could do it this way. If you don't like doing it this way, there's another way of doing it. Your beginning raw material is 32,000. My purchases are 276, and they told us my ending is 28,000. And what we do is that we used it into the production. If they're used, it is moved from the raw material, it goes into my work in process. So in work in process we have our direct material, direct labor, and manufacturing overhead. So we done the question, and this is my answer. Now we're going to go to my next one. It says, what is my total manufacturing cost? So when they're asking for total manufacturing costs, that can be relate to the product. We are going to have a direct material, direct labor, and we're going to have my manufacturing overhead. Did they tell us all of them? Yes, we have a direct material, which is your 280,000. Direct labor is 375, and we have a factory overhead cost which is 180,000, and that is called my total manufacturing cost. If I add all these three numbers, and I will get a number, it will be 5, I don't know, 835. So should be 835. So that's what will be my total manufacturing cost. Going further, let's go further. Now what we're looking for is, we're looking for not total, we got the manufacturing, now we're looking for cost of goods manufactured. For that you need a working process beginning. So we have a beginning working process, and then we have a total manufacturing cost. And then we learned it, what that represent my direct material, direct labor, and my manufacturing overhead. We already worked it out in the previous question, that was 835. They also told us in the question is 835. Beginning working process inventory, WP stands for work in process inventory. That is your 125,000 plus my total manufacturing cost. And then they said there were 20,000 of the inventory that still remained. So we know that we have to minus the ending working process. That will give me working process, and that is your 200,000 that we needed to minus it, and that will give me cost of goods manufactured. I'm just waiting for my pen to come back. So then before we get to it, when you have it, beginning work in process plus your total manufacturing, and you're going to total them. So let's see, what do we get? That is your total work in process during the period. So if I add these two numbers, that is total work in process during the period. If I add them together, and I will get 960,000, and I minus my ending working process will give me cost of goods manufactured. The cost of goods manufactured, and that is, if I take away from each other, that will be your 960,000, and that should be the answer C. Now going further, of course we have going further, they told us now we're going, once you manufactured it, it goes into your finished goods. So we have a finished goods inventory, finished goods, beginning finished goods inventory. They told us it is 130,000. We the goods that we manufactured, the cost of goods manufactured that we calculated, cost of goods manufactured that we calculate is, I add the 760 to it, and once we add it, something is wrong with my pen, it's not coming back. I'm going to just get another pen. So if I add both of them, I am going to get I needed to calculate a number. So what so I have a cost of goods manufactured, and that is my 760,000. So that I add these two numbers, and then what do I get? I have total finished goods inventory. This is your total finished goods inventory. If I add these two numbers, and I will get 890,000. And what we do is, we know that we want to know how much we sold. So what we do is minus my ending finished goods inventory. I minus it. In this case, it is $150,000. And what am I left with? My cost of goods sold. And that will be the difference between the both. And I think it will be 740,000. So the answer should be 740,000. So that's how we calculate the cost of goods sold. Now this topic isn't as hard as it sounded like at the previous. Now we have more cost. We have a variable cost and we have a fixed cost. Variable cost changes according to the activity. Fixed remains the same. So fixed is fixed, it means the same. So now this is an example showing you what if it's a what is a variable cost and what is my fixed cost. Now think of it, you have a telephone, you have a cell phone, your total texting bill based on how many texts you send. So your unit variable cost per unit doesn't change, but the total variable cost changes. So per unit cost, we have something called per unit cost and the total cost. So when we have a variable, your per unit cost does not change, but your total changes because according to your activity. Now it's saying that the cost per tax cent is 5 cents. It's constant, so it's per unit. That doesn't change. Per number of your driver will be how many texts you send. If you send 100 texts, then your the total variable cost will be $500. So that's what will be your $500. So we think of a cost driver. So what does it means? What drives your cost? So units you produce, that can drive your cost. If you have a car, the miles you drive, that can change your cost. The machine hours, the labor hours, these are my activities. They drive my total variable cost. So these are the drivers and they drive the total cost. So that's what it means. Fixed cost does not change. Like I said, that it stays the same. So it does not change. So it does not change on number of calls or number of the texts that I make. So now we have a relevant range. So what happens what is a relevant range? Relevant range is the range of activity within the assumption about variable and fixed cost behavior. So we're going to be learning about this in our next one. What is it doing is, what happens is sometimes within a company, what we have is we have a mixed cost. Under the mixed cost, some are variable and some are fixed. So what we needed to do is we needed to separate. So the part of when we think of a mixed cost, part of the cost is variable and part of the cost is fixed. Just give me a minute. I think there's a problem with my system. I hope I'm picking up where I left off with. We were talking about the mixed cost. When you have a mixed cost, the cost has both variable component and the fixed component, and that's why it's called a mixed cost. When you think of this is just a summary of variable and fixed costs in total, in a total and in per unit cost. So when we think of a variable, total variable cost change as the activity level changes, and the variable cost per unit remain the same. There is no change in the per unit cost. When the fixed is, total fixed cost remains the same when the same even though the activity level changes. Now the average fixed cost per unit goes up or go down depending on the activity. So let's look at it and see if we can pinpoint what the next example is asking us to do. So it says which of the following cost which of the following cost would be variable with respect to number of cones sold by Baskin and Robbins shop. there may be more than one correct answer. So what we're doing is, where it's a ice cream shop, what they do is they sell ice cream. So we want to know which one is a variable. So you could have more than one variable cost. So the cost of light lighting the lightening the store, that will be a fixed. The wages of the store managers, that will be fixed because it doesn't change. The cost of ice cream does change because it depends on how many ice cream we sell, and the cost of napkins for customers also going to be variable. So these two are my variable cost, where the cost of the lightening the house, the store, and the manager wages are fixed. Now, assigning cost to the cost objective. So remember we said that we talked about the drivers and how do we allocate the cost to the cost objective. Cost objectives, any units of analysis for which cost data are desired, including product, customer, job, and organizational subunits. So that's what it means. Now we can either for assigning cost to the cost objective, costs are classified as either is this a direct or indirect. So the cost could be direct if it's related to the product, it'll be indirect if it's not related to the product but it's indirectly, then it will be an indirect cost. So these are some of the examples of the direct cost and the indirect cost. Remember we learned direct material, direct labor, they are traced to the product, they become a direct cost. Indirect cost, in any indirect cost, indirect material, indirect labor, they're part of your manufacturing overhead. Now they said fixed cost stays the same, doesn't matter how many, it doesn't matter, per fixed cost per unit, that's what it means, per unit. Within the monthly contract allotment, the average fixed cost per cell phone call may decrease as you make more calls. The more calls you're making, and the cost per unit, so per unit is changing, so per unit will be decreasing. When we think of decision making, so of course every decision involves two alternatives. Only those cost and benefit that different between the alternatives are relevant. So if the cost of one project is higher or the benefit of that project is higher, it's going to be relevant to making a decision. Otherwise all the other things does not change your decisions. So only if it's a cost and a revenue, that's going to change your decision, nothing else is going to be making a difference. So a difference in cost between the two alternatives, if there's a cost difference, we call it differential cost. If the difference is in a revenue, we call them a differential revenue. A differential cost is also known as an incremental cost, an increase in cost from one alternative to another alternative. Now, next cost that we're going to learn about is we're going to learn all about costs in this chapter. Opportunity cost. When we think of an opportunity, you gave up something to get another. So the potential benefit that is given up when one alternative is selected over another. This is an example. If you were not attending a college, you will be earning 15,000. Your opportunity cost of attending for 1 year's 1 year school is 15,000. So this is an opportunity cost. You gave up something to get something. So what you did is, they said if you're not attending, you'll be earning. So if you don't go to work and you decided to come to school, then you're giving up your earnings. So that's what it is. Sunk cost is a cost that already happened and it cannot be changed now. So it's already happened, we cannot change it. What will be a sunk cost? You bought an automobile for 10,000 2 years ago. The 10,000 cost is a sunk cost. We cannot, whether you drive it or take a bus, it doesn't really matter. You park the car, you drive the car, or you trade it, or you sell it, cannot change. Sunk cost is you already bought something. Now, of course, you made the decision to buy the car, so you bought the car. That's your sunk cost. Let's look at it, looking at it, which is a relevant cost and which is not relevant. Suppose you are trying to decide whether to drive or take a train to Portland to attend a concert. So you decided to attend a concert. Either you take a train or you drive. So you have two options. You have ample cash to do either one, but you do not want to waste money needlessly. Um, is the cost of the train ticket relevant to the decision? So we needed to know yes or no. Yes, the cost of the train is relevant. No, the cost of the ticket is not relevant. So now, if you're gonna go to the concert, regardless how you're gonna go, you drive or you train. So the cost of the train, first one is relevant or not relevant. So to me, the cost of the yes, the cost of the train is relevant to us, um, um, at this point, because um, you are going to go to Portland, either drive for a concert. Either you drive or you take a train. Now the next one is going is we're looking at is the annual cost of licensing your car is relevant or not. Suppose you're trying to decide whether to drive or take a train to Portland to attend a concert. You have an ample of cash. Um, you have an ample of cash to do either, but you do not want to waste needlessly. Is the annual cost of licensing your car relevant in this decision? No, it's not. Because at the end of the day, if you have a car, you have to get a license uh, for the car. So it doesn't matter if you drive or you take a bus. Annual cost is not relevant. Is not a relevant cost. Going further, now the sunk cost is it already happened. So we want to know. Suppose that your car could be sold now for $5,000. So if your car will be sold for $5,000, is this a sunk cost? No, it is not. We haven't spent the money. If you think of it, if you bought the car, the buying the car is a sunk cost, but selling the car is not a sunk cost. So these were some of the costs. So we have gone through lot of quick questions, quick multiple choice questions. They're always good when you're learning the material. Thank you so much for listening. I will do another recording for the questions at the back of the chapter. Thank you for listening. Take care and bye for now.